Welcome to Kenton Teaches. Enjoy the video.
You begin by opening your tracking tool and logging the first trade immediately. You don't need perfect formatting. Enter date, ticker, size, direction, and entry price so you capture the trade context. Add the strategy name and the time frame. This helps you group similar trades later. Also write a short objective: scalp, swing, or position. Once done, save a single row template to reuse. This reduces friction and keeps you trading, not formatting. Once the trade is active, update the journal with management actions. This is where discipline shows. Document your initial stop and target plus the risk percentage of your account. If you scale out or move stops, timestamp each change and explain why you adjusted. This reveals decision patterns. Record fills, commissions, and slippage for accurate performance. Make sure to note emotion or news that affected choices. These qualitative notes explain the how and the why behind results. You finish by reviewing trades on a set cadence, weekly then monthly, to turn data into improvement. Calculate win rate, average R, and expectancy, then compare strategy groups. Annotate charts with entry, exit, and reasoning. This visual audit reveals recurring mistakes. If results look off, troubleshoot one variable at a time: position sizing, execution, or strategy fit. Key tip: if you can't find the error, replay the trade on a chart. Often the timing or emotional reaction is the culprit.
Thanks for watching. Please subscribe if this video was helpful.